Welcome to the Unlocking Business Credit course, hosted by the Urban League of Greater Philadelphia.
Okay, well, you are in for a treat because we have our one and only, or the one and only, Kevin Lewis from Premisien Credit Counseling. He's a specialist with us who not only assists individuals and companies with building personal credit, but also building business credit.
Unlocking business credit and the power of personal credit. I'm going to start this off by telling you what is frustrating to me a little bit. There are a lot of people, there's a lot of white noise on the internet that says that you can get business credit without personal guarantees or without people pulling your personal credit or without using your social security number. There is a small piece of the marketplace that holds true, but for the most part, that is not true. No major lender is going to give you money without looking at your personal credit and potentially asking you to do a personal guarantee unless your business is doing revenues of $3 million or more annually. Now, there are some exceptions to this, very small and very infrequent exceptions, but there are exceptions to this. This is not a rule, it's this commonplace, but there are exceptions. But for the most part, you're going to need to have a pretty solid personal credit history, a personal credit profile in order to get major business credit lending. Ladies and gentlemen, it is best practice to work on fixing your personal credit issues and building your business credit before you get to the emergency. And ladies and gentlemen, you will have an emergency. There is no business that is immune. You will have an emergency. Now, some of those emergencies are not negative emergencies. Some emergencies are you have an opportunity to buy a piece of equipment at a discounted price, or you have the opportunity to get a piece of real estate for your business, and the deal is too good to pass up. But because you haven't fixed your personal credit issues or you haven't established business credit, it makes it very challenging, if not impossible, to get that credit. So my suggestion to you is address those things as soon as possible, build that business credit so that when these things come up, and they will come up, you are prepared to take advantage of the opportunities and overcome some of the challenges that you might face. Your payment history is the most impactful. If you make a misstep in your payment history, it is going to cost you the most points. And I'm going to go through these and I'm going to tell you what to do if you do have a mishap and what to do to make sure that you don't have a mishap. So you should not have any missed payments within 24 months in your payment history. In order for you to be, so we call credit, we go red, yellow, green. Red means you're not doing well in that category or that component. I'm gonna call it component. Yellow means you're doing okay in that component, and green means, of course, you're doing great. If you want to be green in the payment history component, then no missed payments within 24 months. However, if you do have a missed payment within 24 months, you can write a letter to the creditor or call the creditor. I would write the creditor and ask them, if you only have one within 24 months, this is easier to get done than if you have more than one. But call the creditor and ask them to do what's called a goodwill removal. Now, you need to have a great reason for missing the payment, but ask them to do a goodwill removal of that entry. Some will, some won't. All creditors have the ability or the authority to remove those missed payments. Now, if it was a mishap on their part, then you definitely have a right to ask. But if it was a mishap on your part, if you have one or two, if you have anything outside of three, it's very difficult, if not impossible, to get those entries removed from your credit report. But it doesn't hurt to ask. The second component is credit utilization. That's the next most impactful factor. This, most people would say less than 30%. I say less than 25%. I'm going to tell you really quickly how to use your credit so that you can use all 100%, but you can still not go above the 25% threshold. There are two dates that you should be concerned with in all of your credit. The first one is the due date. That's easy to know. They'll tell you as soon as you sign up, they'll tell you what your due date is. The second one is the reporting date. That is the date that the creditor reports your balances to the credit bureau. It's also called the statement date. So in credit utilization, I want you to use no more than 25%. Industry says 30, but I say 25. So let's say you have a credit card that has $1,000 limit on it. I'm telling you, I don't want you using more than $250. But what I actually mean is you can use all 1,000 of those dollars. You just need to pay down the balance to at least 250 by the reporting date. The creditor will actively give you or openly give you the due date. But the reporting date is something that you have to mind for. So you want to call all of your creditors and note several things about your credit. You want to know the due date, the payment date, the minimum payment, and I said the due date, the reporting date, the minimum balance, and the interest rate. You want to know that and note that somewhere so that you know what you're being charged and you know how your bills need to be paid and when you need to pay down those balances. So you can use all the money on a credit card, but just make sure you're paying it down to 25% by the reporting date. Okay, the third factor is credit age. That's the length of time that you've had your credit. What they do in credit age is they take the time that you've had they add all of the time that you've had all of the credit entries on your credit report and they divide by the number of credit entries. So if you have 5 credit entries and you've had your credit for 25 years, your credit age is going to be 5 years. The only thing that you can do in this category is to wait the 7 years. In order to be good in this category, you need to have 7 years worth of average credit history. There are only 2 things that you can do. I only suggest one of them. Wait 7 years. The other thing is you can become an authorized user on someone else's credit. If you're going to become an authorized user on your credit card, or you're going to make someone an authorized user on your credit card, there are 4 criteria I tell people to adhere to, and like I said, I won't go over them tonight because I want to be respectful of time. Just know that you need to have 7 years worth of credit history. The fourth one is I'm gonna flip these because they are equal in impact. So I'm gonna go inquiries, new credit, hard credit. There are 2 types of inquiries that a creditor can do. A creditor can do a soft pull, which means they only use some of the information that is on your credit report to determine whether or not you will be qualified for something, or a hard pull, which is they're using all of the information that's on your credit reports to determine whether they're going to approve or deny. Soft pull does not cost you any points on your credit report, nor does it have a negative impact. So if you can, whenever you're applying for credit, ask the creditor, can you do a soft pull? Most of you will see soft pulls when you're doing pre-qualifications. So if a credit card or a loan says you're pre-qualified for a loan, they send you this marketing says you're pre-qualified. If you answer that marketing, whatever that thing is, if you answer that solicitation, then they'll do a soft pull to determine whether you're going to get approved. Then you do an application and they may do a hard pull or they may only do a soft pull. You can ask any creditor to do a soft pull. Some will, some won't. Hard pull is going to have a negative impact on your score, about 3 to 5 points per inquiry. I want to let you guys know that credit scores are for the consuming public. credit profiles are for the bank. What I mean by that is when a bank looks at your credit, you could have a really great credit score and still get denied credit because of things like credit mix or inquiry. So you could have a 776 credit score and still get denied for a credit card because you have a lot of hard pull inquiries on your credit report, or you don't have enough credit in the categories that I'm about to go over. When I talk about credit mix, that is going to be more prevalent. That happens more often when people don't have enough credit, what we call thin credit. So let me go to that. But let me close the loop on inquiry. The inquiry is going to be, hard inquiry is going to cost you 3 to 5 points per inquiry. And the more inquiries you have on your credit report, the better, the worse your credit profile looks to a creditor. Credit mix, the fifth and final one. They are equally, credit mix and inquiries are equal in impact. There are 3 categories of credit. Installment means you pay the same amount every month, no matter what the interest rate. That's like a mortgage, a car loan, student loan, personal loan. Revolving is you pay a different amount depending on what you use and the interest rate. That's a credit card. And then there's open. That's an industry term. So we call it open. You guys would know it as a no preset limit card. That's like, I won't use the names, but one of the companies starts with an A, one of the companies starts with a D. That's where they give you those cards that have no preset limits, means you can go run it up, and then they'll ask you to pay a portion of it all at once, and then they'll let you pay over time for another portion of it. You guys would know those as a no preset limit card. In personal credit, this component is very, very important as it relates to business credit. Because if you do not have a substantial credit profile, a substantial credit mix on the personal side, it could prevent you from getting business credit on the business credit side. By the way, in business credit, and you might hear me say this later on tonight, in business credit, unlike personal credit, if you get denied for personal credit, usually the creditor is going to send you a letter and they're going to tell you in bullet points all of the reasons why you got denied for that credit on the personal side, or what we call the consumer side. But on the business side, they don't have the same rules. A business might deny you, or a creditor might deny you business credit and just say, we denied you credit, we're unable to extend it to you at this time, and they won't tell you why. They won't tell you that it was because of your credit mix on the personal side. They may not tell you that you're missing one of the components on the business side. So it is in your best interest to find out what would stop you or prevent you from getting approved for business credit. In the credit mix category, in order to be green in that category, you need to have a 2-3-2 relationship. You need to have at least 2 installment accounts. Installment account is your mortgage, your car loan, your student loans, your personal loans. You pay the same amount every month, no matter what the interest rate is. You need to have at least 3 revolving accounts, and revolving accounts are just credit cards. And you can have a mix. I would tell you, if you only want to have 3 credit cards, get a Visa or MasterCard, get a store credit card, and get a fuel card, a card from a gas station. And then 2 open accounts. Again, the company that starts with A, no preset limit. The company that starts with D. I don't say these names, even though I said Visa and MasterCard, so I might as well. Amex and Discover. The no preset limit cards. Those are open. Those are what we call open accounts. Reason that a business creditor might deny you credit is because, again, they're going to be looking at your personal credit to determine whether they're going to lend to you. And if they are a lender that is lending you installment money, they want to see how you pay the installment money back on your personal credit. If they are a revolving lender, they're going to be looking at your revolving accounts. If they are a no preset limit lender, they're going to want to be looking like line of credit. Line of credit they look at your personal credit and they look at the number of open accounts and how you manage them. So if you have missed payments on revolving credit accounts in your personal credit report, when you go to get a business credit card, they're going to be looking at that and you could get denied. And again, the creditor has no legal, there's nothing legal that says the creditor has to tell you why they're denying. Business credit worthiness. Business creditors almost always, if they're lending any substantial amounts of money, meaning amounts above 10,000, they're going to be looking for personal guarantees. They're going to be looking at one or all of the business owners to guarantee on their personal credit. Now, that credit, if it's true business credit, may not show up on your personal credit report unless you default. But once you default, they will put those defaults on both your business credit and your personal credit. So just know if you have some challenges, some blemishes in your personal credit, please fix them. They also, a lender, particularly if you are new to business credit, if you're just starting, and I don't mean you're just starting out in your business, but if you've been running your business 2 to 3 years and you go to get a loan from a bank and you've never had a loan in your business name before, you don't have a business credit history. So they're going to be looking at the business owner's personal credit history to determine whether or not they're going to lend to you. And then financial stability, the personal credit gives an indication of how you will manage business credit. There are 8 personal credit bureaus. You know the major 3, Equifax, Experian, and TransUnion. But there are 5 what we call secondary bureaus. So the 3 that I just named are the primary bureaus. There are 5 secondary bureaus. There are actually 4 now because 2 of them merged. So the 5 secondary bureaus are LexisNexis, SageStream, ARS, CoreLogic, and Innovis, INNOVIS. CoreLogic, for those of you who have applied for a mortgage recently, that's the credit bureau that, besides the 3 credit bureaus, that's the credit bureau that most mortgage companies use to find out about your mortgage history. If you've had property, if you've had any rental history that's been reported, that's CoreLogic is where that information comes from. And you need to check all of the erroneous information that might be present with all of those bureaus. If you just use the name of that bureau and put .com behind it, you can get to their website and pull a credit report from each one of them free of charge 1 time per year. I want to give you a quick strategy for using credit. Use your credit cards as debit cards. You've got $600 in your account for groceries. Use your credit card, put those $600 worth of groceries on your credit card, and the next day, use the cash that you have in the bank to pay your credit card off. The reason I'm giving you that as a strategy, it is not a rule, it's a strategy, is because 1, you'll amass rewards points and you can use those rewards points to do things like hotel rooms, flights, rental cars, etc. And you get the credit card company to pay for it. But also, you have some protections on credit cards that debit cards don't give. But that is only a strategy if you can do what I'm saying do. Use the credit card today is Wednesday, pay the bill tomorrow, which is Thursday. And that's how you build credit. Establishing business credit, obviously you have to have a business. I'm not even gonna go through this because all of you on here should have gone through this process already. Just a quick note though, about your documents. Please keep your business documents. Your certificate of organization, depending on the state you live in, it's called something different. It could be called certificate of formation or certificate of organization or articles of organization, depending on the state you live in. But the document that you filed to start your business in the state, please keep that document. The document that you file with the IRS, which is your EIN document, your EIN certificate, please keep that document, and you should always have an operating agreement. Those are the three things that you need to always have. Please keep those things, but also, ladies and gentlemen, please make sure those things all say the same thing. If your EIN says Kevin's Home Repairs and your certificate of organization says Kevin's Home Repairs Enterprises, that would be a reason for a lender, a business lender, to deny you credit. And again, they may not tell you that they denied you credit for that reason, but they may deny it. In order to get business credit, the creditors want you to have consistent payments. They want to make sure in business credit, so in personal credit, I talked about the 5 components. In business credit, consistent payments. In personal credit, we talked about the 5 components. In business credit, the only 2 components that a creditor really concerns themselves with is your payment history, and that's on both the personal side and the business side, and your limits on your credit. So what I would tell you to do, in addition to having all 7 credit lines on your personal credit, remember we talked about a 2-3-2 relationship, 2 installment accounts, at least 3 revolving accounts, at least 2 open accounts, at least. So that's 7 trade lines, at least. In addition to having those 7 trade lines, you also want to increase the limits on your revolving trade lines often. So I tell people, I tell my clients, every 6 months on your personal credit, raise the limit. Most creditors on your revolving credit, most credit card companies will do that without doing a hard pull. They may charge you a small fee, but it's a small price to pay. Do that because in business credit, what the creditor looks at is the total amount of credit that you have. They don't care about the utilization. They just care about the total amount of credit. So if you have $100,000 worth of credit amongst those 7 trade lines on your personal credit, then a business creditor is going to feel more comfortable about giving you 200,000, 300,000. Of course, your revenues have to dictate, or your revenues dictate how much that is. But they will feel more confident giving you that money because someone extended you that money on the personal side. Same thing on the business side, though. If you have revolving accounts on the business side, every 6 months, increase the limits, because the more you have, because in personal credit, the only 2 things that they really are concerned with is your payment history, and the limits or the amount of credit that you have outstanding. Business credit reporting. We talked about the 8 personal credit bureaus. There are 4 major business credit bureaus, no minors. 4 major business credit bureaus. Dun & Bradstreet, Experian Business, and Experian Business is separate from the consumer division. Experian Business, Equifax Business, and now Credit Safe, which is slowly creeping up to dominate the market. Now, every business credit line does not report to all business credit bureaus, and some business creditors do not report to any of the business creditors. Some of them don't because they don't, but some of them don't just because you haven't asked. In personal credit, every entry on your personal credit report is called a credit line. In business credit, every entry on your business credit report is called a trade line. In order for you to have a substantial business credit profile, you need to have at least 10 trade lines reporting to the business credit bureaus. I'm going to tell you which ones I would suggest you have and the amount. And it's going to take you some time to build those trade lines. So the first one I would tell you is to get 4 vendor accounts. A vendor is a company that will sell you products and services and invoice you for those products and services. One of the most notable is Uline. Another one is Quill. And I'll stop right there because there are a host of them. I just want to give you the ones that you guys might have heard of. Particularly if you've been on social media and there have been people in the space talking about how to build business credit. Definitely 4 vendor trade lines, 4 separate vendor trade lines. And you want to make sure before you get products and services from these companies, make sure they do report. So they'll sell you the products and services. They'll usually do what's called a net 30, net 60. For those of you who don't know, just mean that the number at the end of that net means that's the amount of time that you have to pay the invoice. They invoice you on January 1st. You have until February 1st to pay that invoice. Net 60 means you have 60 days, net 90, so forth and so on. So 4 vendor accounts, 3 revolving accounts. That's 3 business credit cards. Again, make sure business credit cards are reporting to at least one of the business credit bureaus. If they don't, ask them to. And then you want to have a mix of, there are 17 other types of business credit out there. I'll just quickly yell out a few. There is equipment financing. There is vehicle financing. There are term loans. There are revenue-based loans. There are credit union loans. And the list goes on and on and on, but let's stay right there. I would like you to get a mix of one of the 17, and I just named a few. Like I said, there are others that we can discuss in one-on-one individually. But I want you to have 3 of those, combination of 3 of those. And I'm going to give you another strategy real quick. One of the things that is the most harmful thing in personal credit is that payment history, because it is the most impactful. If you miss a payment in your personal credit on something, meaning you're 31 or more days late, it could drop your score, your personal credit score, by 50, 60. I've seen it drop as much as 70 points. And you're going to have to pay the bill, all of your bills. You're going to have to pay all of your bills on time every month for 24 months straight, no break, to get those 50, 60, 70 points back. In business credit, let's say you're using one of those vendors. They give you a net 30. The earlier you pay a net 30 or net 60 or net 90, the better your business credit rating is going to be. In personal credit, you can pay the bill early all you want. It doesn't give you any positive impact. You miss it, negative, but pay it early, not positive. Business credit, you pay it early, positive. The earlier you pay, the better it is for your business credit. But also, if you pay it late, let's say, so on your personal credit, let's say you paid 31 days late, you're late. The equivalent to that in business credit, let's say that net 30, let's say you paid it 2 weeks late. So you paid it 14 days late. Your business credit score or rating is going to drop. But all you need to do to fix it is the next time you do a net 30, and it doesn't even need to be with that creditor. The next time you do a net 30, pay it 14 days early. So pay it instead of on the 30-day mark, pay it on the 14-day mark. Now you'll get those points right back. So essentially, you could get the points that your business credit score dropped in the same cycle. There's this thing that we call, this strategy that we use called loan stacking. Many businesses that I encounter know business credit as business credit cards, lines of credit, or term loans. But like I said, I'm just going to rattle some off again. Merchant cash advance, vehicle financing, equipment financing, revenue-based loan, credit union loan, term loan, line of credit. And I'll stop there. There's several others, right? So now you are, let's say you want $100,000 from the bank and you're going to go get a term loan. You're going to apply for a term loan for the $100,000. You're going to use 25,000 of that to buy a vehicle. You're going to use another 25,000 of that to retrofit that vehicle. You're going to use another 25,000 of that for marketing, and you're going to use another 25,000 of that to pay some employees or working capital, right? So you get this term loan at 10%. The first thing is you go to get the term loan. I have seen banks. I have a client right now who has been applying for a term loan since May of 2024. Still has not gotten through the entire process. Got approved, but still hasn't gotten through the process. Now, she needed the money in January of 2024. So when she started the process in May, she was working from behind. So it's taking a long time to get that term loan. And that person is probably paying 9.5%. Where the person could have done vehicle financing with a vehicle financing company for $25,000. And a vehicle financing company, all they do is vehicle finance. So their process for processing your paperwork is a lot faster. Some of them can do the financing in 24 to 48 hours. The next piece is equipment financing. Same thing. Company does, all they do is equipment financing. They can finance within 24 hours and they may charge you 3%. For the marketing, you might get a credit union loan, might come in at 5%. They may take 2 weeks. And then for the final 25%, there you might do a line of credit. That might cost you 9.5%. But that line of credit is only for $25,000. More likely you get approved, and that will take you a lot less time than that $100,000 term loan. Collectively, you've not only cut down on the amount of time it took you to get to that money, but you've also saved interest, because remember, you're doing the average interest. So you're 9.5, you're 7, you're 3, and so you're going to pay a lot less money for that same $100,000. That's called loan stacking. That's why it's important to note that there are other types of lending besides the ones that most people try to use. To secure business funding, we talked about personal guarantee. We talked about having a strong personal and business credit history. You might want to find someone who will co-sign for you. Bring somebody onto the loan that does have collateral and is willing to put it up. That might be an equity partner in your business. That might be a debt partner in your business. It could be that it could be a joint venture. There could be a number of ways that you can get access to that financing without collateral. Co-signer is one of the ways. And then, of course, having collateral. Now, here's the thing that I want to talk about in collateral in your business. Ladies and gentlemen, every financial law in this country, the people who know me have heard me say this 100 times. Every financial law in this country was written so that businesses could take advantage and consumers would be taken advantage of. That said, put everything you own in your business name. Everything in your business name or in the name of a business. Everything. The home that you live in, the car that you drive, the vacations that you go on, the clothes that you wear, put all of those things in your business name, because you get so many more benefits from your business. Put everything you own in your business name so you can take advantage like other people take advantage. And one of the advantages is putting those things in your business name. Again, buy stock in your business name, bonds, gold. Buy those things in your business name, because the more collateral that shows up, the more assets that show up on your balance sheet, the more lending you get. How do we put everything in our business name? Well, I'll give you an example. let's say you have a mortgage right now. A mortgage is a consumer product. So when you hear me say that, that means someone used their social security number to get the lending to buy that property, right? You have a mortgage. You go acquire a business loan. Do not transfer. There's no transfer. Go acquire a business loan and let the bank know you're getting real estate based lending, commercial real estate based lending to buy a property. Get the amount of money that you owe on that mortgage, and then take that check that was written out to your business, take it, pay off your mortgage. Then go transfer the deed into your business name. So you paid the mortgage off. You now own the home free and clear. Now you take that to a real estate lawyer and have that deed transferred into the name of your business. Same thing with your car. You have a loan on your car. Go to the bank, get a loan, pay the car off, go down to motor vehicles, take the title. You're gonna get a clear title. Take the title to motor vehicles, put that car in your business name. Now you have those two assets. They are collateral. Now, when you go to get a loan of $250,000 for your business, they're going to use that collateral, or they're going to use that asset, your balance sheet, and say, you know, we'll give it to you because if you default, we'll just come get this property.